the loads. I'll try to give you, I'm a macroeconomist in practice, so I look at the economy from a 36,000 feet view, which is, it's like, you feel like you've flown over India, or maybe what. If you want to dig deeper into anything specific, you please stop me and you're free to ask me about it. Well, as you can see, I think in the slide, I think things are not very smooth. It's very turbulent waters right now for everyone. I began my career sometime in 1988, and I've seen three big crises since then. The first one was home loan, 1991, when I think India faced a balance of payment crisis where we didn't have the money to pay for our imports, something that is happening in Pakistan right now. Then I think the big crisis after that, the big one which actually shook the world was 2008 global financial crisis. And I think that taught us many things. And we were not able to fully recover from that. Another crisis with us, which was a crisis which you did not know how to respond to, which was the pandemic. And I think, so pandemic was, there's no playbook with the economists as to how to assess what's going to happen, because we did not get pandemic in the last 100 years. So nobody was bothered about it. Now I think it's becoming a part of curricula also, and people are trying to look at what it does to demand, supply, and so on and so forth. So right now, where we stand right now, we have a situation where we are out of the pandemic, for sure. Maybe some parts are facing difficulty, China for instance. But it's not causing any functional disruption. I think I don't see anybody with a mask. When I walked in, I had a mask, then I took it off because I figured out the protocol. So all activities are going on. But despite that, I think there is a lot of discomfort, I think, because of what's happening around the world and how it's going to impact us. And 2023 is the year when the peak impact of all the troubles which I think are expected in the global economy are likely to show up. So I think that's the broad context. With that context, I think I would, let me point out, I think everybody reads the papers, you know the inflation is very high globally. When inflation is high, the central banks try to raise interest rates. They have to slow down the economy and control inflation. But what's happening is there is almost certainty that economies are going to slow down, particularly the advanced ones. But whether inflation is fully controlled, I think nobody is so sure. So I think that creates a lot of uncertainty as to how much interest rate hikes you can expect from big central banks like the Federal Reserve or the European Central Bank, etc. For India, I think it's been an outlier in the sense that our growth performance has been somewhat better than expected. And we've also kind of, I won't call it decoupled, but I think we've kind of managed to have our own trajectory, which I think, which is now being appreciated across the world. I think India appears to be one of the big growth stories right now. I think there is a lot of hope centered around India being a large economy that's going to grow faster, and what that means for the rest of the world. So there is a change in the narrative. The narrative has turned a bit positive for India since the pandemic, I would say. Before the pandemic, it wasn't that positive. It's just in the last 1 or 2 years that we've seen that. So economy, as per the National Statistical Office, grew at 7%, the GDP. Next year it's going to slow down. I'll talk about that, why I think. Next year, I mean next fiscal year. Fiscal year is from April to March. I think what we're experiencing right now is a very strong rebound in contact-intensive services like hotels. It's very difficult to get a hotel room. The prices have gone up. People want to travel. So all those things so there is a surge. So when pandemic struck, what was working was agriculture, your utilities. We didn't face a power problem ever during the pandemic. Then I think slowly manufacturing started coming back. Services was the last one to come back because it is contact intensive, I think. So now we are seeing a situation where contact intensive is in the driving seat. Good thing is that people have also started consuming, so private consumption is going up and investment cycle is also showing some signs of pickup. I think these are two important components of GDP. Now the problem that is emerging is in the export area. Somebody was mentioning about the Ukraine war hitting the SME flare. I think now you're going to see global economy slow down again hits that, I think, from a different angle. So the big worry from India right now, apart from growth, is also inflation. I think it's not fully under control. I'll speak about that, and it has implications for what happens in the economy. So we have, I think, a couple of things going for us. One of them is the corporate sector is extremely healthy. The CRISIL ratings, we have upgrades to downgrades. So for every downgrade, there are 5 upgrades, which is a very positive feature. They have deleveraged, so when the interest rates were low, corporates got rid of their debt, they are consolidated, so their balance sheets are very good. And banks are also very healthy right now because banks have a low NPAs, non-performing assets, and also because they are well capitalized. So I think these are, and then what the pandemic did was it fast-forwarded the development in the digital segment. I think you would be, if you look 2 years back, you will find a lot of change in the way payments are done, everything. I mean, nobody is using the banks for making payments now. So everybody is switched on to, and all these things enhance your productivity. So I think that's the broad message I wanted to give. Now, let's talk about the world a little bit. What's going to happen in 2023? If you see the chart, I think I have plotted GDP growth for 2022, 23 and 24. These are the forecasts which my parent company Standard & Poor's does. If you notice, US in 23 is expected to grow at minus 0.1%. Eurozone, absolutely zero growth. And then I think you have China, when you're coming towards Asia. China is going to grow precisely because they have changed their policy stance on the COVID. Now, just to very briefly to tell you what this means. So, US is a classic case of what we call overheating in the economy, which means when government spends too much, when interest rates are too low, it pushes consumption up. So, you end up creating a lot of demand. So, there is excess demand in the system. So they have to sort of cool the economy. The central bank started raising interest rates. So they are trying to engineer a slowdown. They don't want a deep recession. So our assessment is also that they will face some kind of a recession, I think, which will probably start from the second quarter onward. But zero growth is what is expected. Eurozone is a slightly different problem. Eurozone has a lot of energy dependency on Russia. US is energy independent. They actually export energy now. So they are getting hit by inflation. They are also getting hit by energy. Then China, I think, very interesting case for COVID, because the people are really confused in China right now, because government was telling them for 2 years that this is a very dangerous virus. You need to be scared of it. We have to stop its transmission. Suddenly they started telling, no, this virus is okay, I mean, you can be exposed to it. So there is a huge amount of confusion, and that actually they are completely open now. And as a result, the COVID is spreading very fast. So now in this environment, what does it mean for India? So I think what's happening is you are seeing the growth slow down in the advanced part of the world, which is Russia, which is Eurozone and US. This is a pretty large part of the world. I mean, maybe half the world's GDP comes from this. So what would it mean for us? So what we typically do is we try to statistically assess, okay, how are we interconnected? So what we did was we simply drew, this is a very simple chart. I think I just have the GDP growth in India, which is in blue, and the GDP growth in advanced countries, which is in yellow or brown color. If you look at this chart carefully, what you will notice is this is 40-year data. What you notice is in the last 20 years, these growth cycles in advanced countries and India, they are interlinked, interconnected, synchronized, whatever term you want to use. Which means that when growth in advanced country comes down, it comes down in India also. Why has it happened? And the reason is that we have got more interconnected. So when people use the term, we are decoupled, I think that's absolutely incorrect. Decoupling happens when you decouple the bogies. I mean, you detach the bogies. You actually got more integrated. You may be more resilient, but you are not decoupled. I mean. Just to give you one example, our exports to GDP were 11% in 2000. Today they are 22%. The extent of finance that comes into the economy is a much larger part of the GDP. So you actually got more interconnected. There is no decoupling. So I think what this simply means is that if the advanced countries slow down very sharply, which I just showed you, US, Eurozone, etc., it's going to spill over to us. Because 45% of India's exports go to advanced countries, and the US and Eurozone alone account for about 34-35% of our exports. So these sectors which are linked to these exports are going to face some hardship in the coming year. So that is the current assessment. Now, so this is for the short-term behavior, I mean what happens this year, next year. But if you look at, there is also a straight line passing through these growth rates, which is a long-term trend. So long-term trend you can say is, you can use, if you want, you can use the term decoupled for long-term trend, because India has been moving up and Western Europe, US, advanced countries in general, the growth has been slowing because they are aging, there are many issues there. But India, because it can invest, it can reform, so it can grow faster. All those opportunities are much less in the advanced part of the world. So I think there is trouble coming in 23, I think, as per this assessment. And I think I already spoke about what the channel, I mean, one is the exports. The second is, I think, what happens is when US is raising interest rates, even if inflation is under control in India, RBI might be forced to tighten the monetary policy because otherwise the US markets become more attractive and the debt flows out of India toward, it chases more yields. I mean, so it will go back to countries where the interest rates are high. So that, I think that is one factor. Second is, I think because so much capital is moving into US, the dollar is becoming stronger and stronger. So rupee weakens, I mean, as a result of that. And then there's also, I think we'll talk about capital volatility in the panel, I'm sure. Huge amount of inflow and outflow, and not orderly but disorderly. So that is what the problem is. So I think these are some of the spillover effects. I think this chart I just have for illustration. These are the three mountains. The first one is, I think, maybe you can call it Himalayas. The second one was Burj Khalifa, because going straight up, which happened in April 21, if you remember. Then came Omicron, where the cases were very high. Now nobody is testing. I mean, so I think even if everybody has COVID, you will not know. So I think the point I'm making is, if you superimpose these mountains with the line that you see, which is the economic activity measured through Google. Google has mobility indicators. What you find is that after January this year, there is absolutely, I think mobility is above its normal level, and there is no impact of COVID on the economy. Functionally, it's not functionally disrupting the economy. And by the way, Google itself has stopped tracking this data now. They said that they will provide this data as long as the pandemic is there. So since October, they are not providing any mobility data. So that also tells you. So this seems it is out of the way. Now, how have we performed? I mean, so when we come out of any crisis, everybody doesn't recover equally. I think there are various lenses that you can use, rich, poor, whatever you want. I've just used one simple lens, which is what is the size of the GDP, how big is the size of the GDP in different sectors compared to what it was in 2019. What you find is government had to spend during crisis, so government's GDP is 14% higher than what it was in 2019. Followed by financial services that were not disrupted at all. Actually, financial sector has done reasonably well during this period. Electricity, you need it. I think so. It was a utility which was completely unaffected by COVID. Now, if you keep going now, in the end you see, so overall GDP is about 10% higher today than it was in 2019-20. But THC, the last one, that is 0.8% above its pre-pandemic level. That is trade, hotels, restaurants, the contact-intensive services. So these are rebounding, but there's a lot of catch-up to do for them. So I think the point here is that you will see activity in the contact-intensive services stay quite robust for quite some time. I think at least for the coming fiscal year also. So not everybody recovers. So that is why I think now people who are employed in these sectors are getting better employment opportunities. Some of the rural folks are also coming back because this is recovering. Now most of the things are gradually normalizing. I think it's the inflation which is the headache. So what I've done is, I mean, in India, in inflation basket, about 45% weight is of food. Then you have fuel, and then core inflation is when you take food and fuel out, right? And then all means the overall inflation. If you see the components of inflation, I think we saw 4.8% inflation in 2019-20, which became 6.2 in 2021, then 5.5. Then I think in the first half of the current fiscal year it was 7.2, and now it is 6.1. So that is the overall trajectory. But what you see is that it becomes a problem when everything is in the red. So everything was not in the red in 1920. It was not in the red in 2021. Everything was not in the red even in 21-22 when we saw 5.5% inflation. Now I think in the first half of the year everything is in the red, which means food is a problem, fuel is a problem, core is a problem. So recently we saw inflation come out at 5.7%. Now RBI is not very happy with that because they're not, I call it a lone chair. So you don't give 3 chairs to this inflation decline. And the reason is it came down because of vegetable inflation coming down. And vegetable, if you buy vegetables in the market, you'll notice that tomato is 100 rupees one day, and after a week it is 40 rupees. There's huge amount of volatility. So this is the most volatile part of inflation. So you have to ignore it. I mean, and for central bank, what matters is the core inflation, which is not moving down at all. And the reason is services are rebounding, so people are spending. There is, I think, hotel rates have gone up, your airlines have gone up, so all services will become expensive. And goods also, because input costs are still very high, so companies are still passing it on. They have also consolidated, so some larger companies have got pricing power now, so they are able to pass on the input cost increases to the end consumer. So inflation, I think, from that perspective remains a problem. But it's a very different phenomena than rest of the world. So if I plot the inflation for India from 2013-14, you'll see inflation is coming down, right? Even though it's a problem that doesn't look that big as it was in 2013-14. If I draw this chart for US or Eurozone, it's just the opposite. They are moving from very low to very high. So it's a much, much bigger problem for them. So they will have to raise interest rates much, much more than we'll have to raise, and so on and so forth. I think Euro area has around 10% inflation. Their target is 2% inflation. US is also still quite high. I think though it has come down, I think it's still at 6.5%. So I think different problems. So now when there is an asynchronicity in inflation across the world, the interest rates will move differently, yields will differ. So capital will keep chasing from one part to the other, and that volatility is what shows up in exchange rate, availability of capital, and many other things. So I think this problem is not fully sorted because RBI wants inflation at 4%. So I think as long as they don't get to 4%, they can't loosen their narrative. I mean, so I think what's happening across the world now. So when the COVID had struck, what we noticed was, I think many things were not available. Chips were not available. Goods were, I think, the electronics. I think there was a big If you wanted a camera for your laptop to do a call, external camera, it was simply not available. Even in Amazon, the prices have shot up by 4 or 5 times. This was for a brief period. So this was the supply chain disruption. Now, supply chain remained disrupted for quite some time. The shipping rates went through the roof, but I think all that is now correcting because, as I said, things are normalizing. So you're seeing the pressure on the supply chain globally has reduced. That is why I think the car industry is doing well. It's not suffering. Nobody is complaining that we don't have the chips for our cars. And similarly, I think energy, food prices have also globally come down a bit, but they are still quite high compared to the past. So this is just a chart to show that I think the average levels are the straight lines that you see, and the bars are forecast for 23-24. So even in 23-24, energy prices or non-energy commodity prices, they are going to remain still high. They are coming down, so they will show up as negative in terms of inflation, but they are still quite high. So that also remains a worry, which means the prices will come down. Now, I think we, again, our ability to see ahead, even for the central banks, is very limited in this environment, which is so uncertain because of several factors. But the consensus is emerging that, well, US will raise interest rates maybe up to 5.5% or 5.25%. After that, they will stop. So maybe another 2-3 rounds. Similarly, Eurozone, etc. Some central banks have given up raising interest rates. Some are not even raising interest rates when inflation is high, like Turkey, for instance. I think they are following their own policy. For India, I think we've done our rate hike cycle is almost over. When RBI meets on February 7th, 8th, they will probably raise rates by 25 basis points. We believe that I think that will be the end of it. And the talk has been very aggressive. Battle is inflation is not over, this, that. But I think their action will be a little softer, I think, because they have to also tame the expectation, I think, of the people. And currency management will be a challenge, I think, all through 23. So you will again see rupee wobbling up and down as the capital moves in and out. So right now, whatever interest rates RBI have raised, they are fully transmitted into the economy. All interest rates, whether it is the loan for a car or for a house, everything is above the pre-pandemic level now. So it will start biting. That's the point I'm trying to make. I think otherwise monetary policy is ineffective. It has to bite. So it will slow the economy a little bit as you go deeper into 23. Even deposit rates have become higher, I think, to the cheer of people who cannot play in the market. The retired people, I think they still have the comfort from fixed deposits in the banks. I think they are now giving them somewhat better return. Well, this is a chart which is, I think, let me give the key messages. And the objective is not to read through what is in the chart. The objective is to show you by colors as to which part of the financial segment is under stress, under duress, which part is still looking good. So I think one big observation is what you see on the top is the domestic part. What you see on the bottom is the global part, because global factors also influence what we call financial conditions. So global factors have been very, very adverse. So I think whether it is the bond yields in the US or the exchange rate movement, crude oil, everything is being very, very unfavorable to us. RBI has been raising interest rates. I think they are now coming into a zone where they will start impacting. But still, I think the contribution of domestic factors to tightening of financial conditions is lower than the global. So as you go ahead, the global factors will slow down a bit because there is going to be a recession in advanced countries. So the crude commodity prices will come down. I think so. The contribution of global factors will come down, but the contribution of domestic factors will rise because the interest rates will start biting at some point, and I think that is it's going to happen pretty soon. Any questions? I think I don't want to move on. If anybody has any questions so far, before I get into some other issues, yes, please.
Hello, my name is Manish Taral. My question is, how do you see the impact of AI, digitalization, technology, and Web 3.0 on the Indian economy in the long term?
Sure. I think I'm going to talk about long term, but let me very quickly try to answer your question. So what digitalization in general does, I think, so all these things are possible because we have much better connectivity now. What digitalization does is it has done three things for the economy. One, it has served as a platform for innovation. So you had startups, etc. I think a lot of AI, etc. People have started metaverse and stuff. All those things are going on. I think that's probably the future. So that is one aspect. Second aspect is it has allowed government to transfer funds or subsidy to the end consumer without any leakage. So you press a button, you have the money in the accounts of people. So otherwise, by the time money left the exchequer and reached the person, I think maybe 30% was left with it, and so that because of leakages, etc. So that part has been covered. And then third impact is the payment system. I think that's been completely revolutionized. So I see these three things adding to the efficiency in the system. So I'm going to talk about it later, that how the medium term trajectory of the economy gets impacted by various factors. So I'm going to bring this technology angle at that time. So.
Hello, sir.
Yeah.
So my doubt is regarding the EMI rates that you just mentioned. So as you said, now they will start biting the common people. So what, according to you, should the changes have been made by the government to tame the devil called inflation in a better way than they have done earlier?
Well, I think part of the inflation increase was due to factors that are outside your control, which is foods, commodities, edible oils. We import 60% edible oil. I think, and then if food inflation goes up, it's largely because of the vagaries of monsoon, which you can't control. Let me give you one example. In March 2022, we saw a heat wave, which was temperature was highest in 122 years. So agriculture follows the rules of the nature. So high temperature meant in March, just before the wheat is harvested, it impacted the yield. The grain size became shorter. So you produce 7-8 million tons lower than you would have generally produced. That led to an increase in prices. And inflation in wheat, even today, is about 17-18%. I think and everything has become more expensive. Now, how do you control this? Now, you can't, globally there is a dearth of, I think India is an exporter of food items, interestingly. We are a net exporter, not a net importer. So there is little opportunity. Ukraine is a major exporter, so you can't plug the gap via importing, etc. So in this scenario, what you do is you try to reduce the shock to the end consumer. So that is why you have this free food grade program, which is 2 lakh crores every year, 3 lakh crores actually last year. So you cushion, so this is one way to cushion. The second, I think, way to cushion is you reduce import duties, which they did for some. But I think the oil part is a little biting. I mean, I think the government policy should have been more proactive in this. Because what they did was, I think I'll just take a minute to tell you, when oil prices have become very low, I think that was the day, and government said that we are not getting revenue and the prices in the pump are very low, so let's raise the duties. So they raised the duties, collected a lot of money, but at that time we thought that they are trying to smoothen the price. So okay, I mean the gap between the pump price doesn't move from 50 to 100. But what happened was, they didn't do that. I mean, when the prices went up, they didn't reduce the duties commensurately. So you felt the impact of that on inflation. And as I showed you, fuel inflation is still at 10%, and fuel and food are two elements which hurt the poor most. So I think the only way government so they did whatever they could fiscally. I think there is not much, because you have to spend for investments. You are also seeing all this infrastructure getting created. Where will the money come from? So you have to balance everything out. But I think the fuel part they could have done better because it cascades. If oil prices go up, diesel prices go up, your food prices also go up because your transportation costs go up. So I think that part they could have been a little more proactive in that. Rest, I think the import duty part, I think what's also happened since 2015 is that after Mr. Trump came in, the countries have turned more protectionist. I think everybody is raising tariffs, import tariffs. We also did that, and import tariffs make imports more expensive. So that is also that also played out. So I think the ball is in RBI's court. RBI is the goalkeeper. So I think it will have to defend. So that's why it's doing its job, I mean, which is the only way RBI can control inflation is by slowing the economy. There's no other way, by the way. They slow the economy, then inflation comes down. They can't reduce the inflation without slowing the economy. So let's be very, very clear. So I think there are many nuances of inflation, I think, which I can keep going on and going on. I can also tell you where a positive intervention from the government actually reduced the prices. You know the story of onions. Every year, I think they shoot up whenever there is a weather event. This year also we had a weather event. October saw a lot of excess rainfall. In Maharashtra, the onion crop was damaged. Now, but the prices didn't rise this time because NAFED had procured a lot of onions. 25% of the onion in November, in the month of November, in the market was let out by NAFED. So the intervention by the government becomes very, very important. And now with the climate changes, which I briefly intend to touch towards the end, I think this will become even more important that government intervenes in the system. Otherwise, I think you will continuously face a lot of volatility in food prices. So I think that's a little long answer to your question. Maybe I can take one more and then I'll return back to my presentation. Yeah.
As you, good morning, sir.
Yeah.
Myself, Ariban. So you briefly touched upon taxes part during the inflation about tariffs. So a large chunk of money that government earns is through taxes. So should there be any tax reforms coming in shortly during the budget session? Because the income tax that we are talking about doesn't constitute a larger part, but the indirect taxes do. So how about so what should be the criteria of the government should be towards the taxes, whether going on with introducing a new tax or going down on the income tax part?
See, I think the tax reforms we've been having continuously for quite some time. The biggest one was the GST. I think in income tax, what we found was that when they reduced the marginal tax rate, actually tax collection went up. So that in economics, there's something called Laffer curve. So beyond a certain, I mean, if you raise taxes beyond a certain level, then you actually lose on your tax collections. So I think you by reducing, now how much scope is there? I think government is not going to reduce taxes in general, that's my sense, but they might tweak the exemption limits, etc. Because see, what happens is every year there is inflation. So if 5 lakh was being taxed per annum 10 years back, today 5 lakh is much lower than that. So you need to raise it to cover for inflation. So that adjustment needs to be done according to me. Second is, I think the GST rates on the average should come down. The Kelkar committee had suggested around 12% average, and average is around 18%. So there is scope for doing that. And then I think corporate taxes you already brought down so sharply. I don't think there's anything that you can do further. So these two things, I mean, the adjusting to give relief to the middle class, as the people are saying, I think the limit for taxation, I think that needs to be adjusted for inflation, which it has not been. I think that's probably, beyond that, government doesn't have much. And even GST, I think they're not going to reduce very quickly. It's a cash cow right now. Okay, so let's move on to exchange rate. Now, I think the narrative that I hear on exchange rate is, I think some people argue that we should have a strong currency. It's like as if it's a muscular strength. that okay, rupee is strengthening, it's good for us. Then there is other side which says that it should actually weaken because otherwise your exports will suffer. So when rupee moves in either direction, there are noises in the system because some lose out, some gain. If you want to go abroad to study, you would want the rupee to appreciate because you will require less rupees for buying your or for providing for your fees, etc. So I think but the fact is that since Indian inflation rate typically is higher than the inflation in countries where we export, so something has to equalize. I think either we become very efficient or we start or our currency depreciates. So there's a purchasing power parity theory of exchange rate which says that in the long run the exchange rate should correct for inflation differentials. So if US inflation is 4%, Indian inflation is, but if US is 2%, Indian is 5%, then maybe 2.5 to 3% depreciation. That is what we have seen. I mean, rupee was in 2008 it was 42, 43. Today it is 80. It's been only weakening. It's not strengthening. That's issue number one. The other thing you see is that the straight line is, of course, currency never moves in a straight line. It sometimes appreciates faster, sometimes it depreciates faster. But what we have noticed is that whenever it depreciates faster, it also corrects subsequently. It's not that it's a given. Although the forecasters, because of the recency bias, they say that oh now rupee is going to touch 90 or whatever. But that doesn't happen. Every time rupee has moved above the line or weakened faster, it also appreciates after that. So on a normal basis, it moves at 2.5 to 3%. I think that's the. Now the issue is there's so many complications. I think including the Russia-Ukraine war, rupee trade which is starting. So there are too many angles which influence the behavior of the rupee. Today, trying to forecast rupee is a mug's game. I think you cannot. So you have to, if you see the rupee strengthened, I think you can probably pay, if you're going abroad, you can pay for your fees much better at that time. But right now, rupee has weakened, but the clamor for foreign travel is still very high. That's because of the pent-up demand, etc. So I think rupee, so there is nothing like that rupee should become strong. It should reflect the fundamentals in the system. And if it has to weaken to support the exports, I think it has to weaken. Otherwise, how will you correct for inflation differentials? Because I think you would be seeing, I mean, there's a lot of noise every time currency wobbles. Okay, so now coming to India, I think let's talk a little bit more about India. So this is what I've plotted is the GDP growth from 2015 onwards. You got the crisis, which was minus 6.6%. By the way, typically India maintains its growth differential with the world. So it grows maybe almost twice as fast as the world, or maybe 70% faster. But during the global financial crisis, when the world was growing at 0%, we were growing at 3.3%. But this time around, I think during COVID, our growth fell much more than the global growth because it was not an external shock, it was also an internal. So both of them combined. So I think India, because of its size of the domestic economy, is able to withstand the external shock. But when the shock becomes internal, then I think there's no window, and then you actually go down much faster. So this is one of the unique years when India went down faster than the world economy. 22 we recovered, 23 is just going on, 22, 23. Now next year I think we see growth slowing down. I think all these forecasts are subject to a lot of caveats and assumptions. One, I think, factor which will slow down the economy is the global slowdown. I've already pointed out how our exports to the advanced countries will suffer as a result of that, and that you can't avoid. Second is the impact of interest rate hikes. The central banks, when they raise interest rate, I'm reiterating it, they control inflation by slowing the economy. So if the economy is not slowing, then I think the policy is not working. So let me put it that way. So it will be felt, I think, next year. Then geopolitics. So how does geopolitics come into play right now? I mean, so I was hearing Ray Dalio, the famous hedge fund guy, he was saying there are five types of war. There is trade war, which is going on between US and China. Then there is finance war. So you also saw financialization of weaponization of finance by cutting access of Russia to various payment systems. So that is using finance as a weapon. Then there is geopolitical dominance war. Then I think there is also there is a military war, I think, which is partly playing out. Full scale hasn't played out as yet. So I think that various types of wars are currently underway right now globally, and they are making the geopolitics extremely complicated. What it means for us is we depend a lot on imports of oil. So oil prices, if you look at the forecast, the range is very high, from 70 to a barrel to $100 a barrel. Now that is, you can't operate in that range. So the people have very low confidence in the forecast. So what the geopolitics will do is that if the global economy slows, demand for oil will come down, so the prices of oil should come down, right? But because of this geopolitical tension, they will make sure that the oil price doesn't come down to that extent. So you will end up with higher oil prices, you will end up with higher commodity prices than they should be. So there is getting hit from both the sides. So all these three factors are coming together, and they are trying to slow the economy. And I think there is very little you can do. We have two tools to fire the economy. One is the budget, and the other is monetary policy. Monetary policy is not growth supportive right now. They say withdrawal of accommodation. That is the statement, which means we are being less accommodative of growth. And fiscal policy, you will see in the budget, government will not do too much to push the economy up. So now I think let's talk a little bit about beyond the current mess. I think why I think India seems to be the flavor right now. So if you look at the long term, in the long term we are all dead, but let's say medium term, let's 5 years or 10 years. What drives the economy is three factors. One is capital, which is investment, capital stock, etc. The second is labor, because you're all working, that's why you're producing. I mean, you need people to produce. And the third is efficiency. So efficiency, economists call total factor productivity. There are several words for it, but what it means is how you combine capital and labor. If you combine it more efficiently, you get more output. So that is when I think you mentioned some about the AI and other things. I think all that is efficiency adding. It will make the system more efficient. So it will allow same investment and same labor to produce more. And that's the point. Now, as far as the capital is concerned, I'm a little positive on the capital side, of investment side, because one, I think government has somewhat focused on infrastructure investment. We can see infrastructure being upgraded and created. Second, I think the private sector is in a position to invest. If you have low leverage, you can borrow more, you can use your balance sheet, but they will not invest right now because of the conditions in the system. So once I think the situation normalizes, private sector will also come in. And then because of China plus one, there is some interest in countries like India, etc. We're talking about friend-shoring, near-shoring. So now what it does is you compromise on the efficiency part here when you friend-shore. Because the most efficient supply chains are in China, and no other country, I think as far as I know, can replicate that right now, at least for the next 5 to 7 years. So, but people want more resilience. They are not so much focused on resilience, on efficiency alone, because if the critical part is supplied by a particular country and it stops it, then it can weaponize it. I mean, that's the point. So you want to trade more with friends. And as a part of that, India will gain because you will get some investments. So far, Vietnam has gained the most, but Vietnam is physically running out of land now to allow new factories. I mean, it's so much. So some part will come to India as well. So I'm pretty hopeful that capital will drive growth in India, investment. Unlike China, which is over-invested, India is under-invested. So China cannot invest more. They have already excess investment, which is turning into bad assets, etc. So India has an opportunity there. Now coming to labor, I think that is where some challenges are there. We have a skill mismatch in the economy. Where you need people, you have a shortage, and where you don't need, you have excess. I mean, there's an unemployable army of labor sitting in the hinterland. And this skill mismatch accentuates every time there is a change in the global order. For instance, we saw digitalization right now. I think faster digitalization. The demand for tech people increased at such a pace. I think everybody was. I mean, when they were interviewing, they already had 3 job offers in their pocket. I mean, so at the same time, I think people are talking of unemployment, lower opportunities. So there is other end where I think, so this skill mismatch is there, and the quality of labor, I think, is also an issue, that the skilling is lacking. Even engineers, when they pass out of their college, they cannot plug in directly into the job market because there is a upgradation that is required. So there is some issue that actually restricts productivity in the system. I mean, or labor from prevents the labor from being more productive initially. So I think labor and India is going to add 100 million to the workforce in the next 10 years, which is so 22% of the increase in the global workforce is going to happen in India, despite falling birth rates. We've already crossed China, I think, a few days back. So, how are you going to employ these people? Now, what's happening is your GDP is growing, let's say, at X rate, even if it grows at 7%. The ability of growth to absorb labor is reducing because you have mechanization, right? And what it means is you need to grow faster to absorb these people. So, if with so many people coming and the labor absorptive capacity of the economy reducing, how do you employ? I think that's a challenge to which nobody has an answer right now, and so that is why you have government collecting taxes and distributing and trying to keep the lid on social unrest in some way. So labor is going to be, and then what has happened during the COVID years, last 2 years. I think it's still being studied, but my sense is it has reduced the ability of the students who went through this new teaching mode, particularly in schools. I think so. Their performance has seriously taken a beating, and it's not that this is not going to reflect in your economy at some point in time. So you need to address that. So I think labor, I'm a little concerned. We have supply of labor, but the quality of labor can become a constraint at some point in time, particularly when you are switching towards newer means of production. And then efficiency. Efficiency comes from reforms. The only reason why India started growing at 7-8% was because it improved its, debottlenecked itself, it reduced tariff barriers, etc., etc. Now, how fast you do reforms, how difficult reforms you do. Now, we privatized Air India. We didn't get any money, I mean, government didn't get much money from that, but at least they plugged the leakages. Every year, so much of loss less. If you do GST, you have a common market, same tax rate across the nation. All those things are very, very positive. So you need to do more of those. But I think the biggest reform that probably India requires is on the legal side, and this is the contract enforcement, and our ranking is 150 or something like that globally. And contract enforcement is the mother of all troubles. I mean, from infrastructure to everything. I mean, from bond market. I think you need. So we have to cover some distance before we make the system. But yes, I think infrastructure upgradation will make you more efficient. Digitalization is making you more efficient. So the efficiency part is gradually picking up and will contribute to growth. I think our forecast is 6.5 to 7% growth. I think it's not about how fast you grow. You can grow at 10% in 1 year. You can even grow at 12%. If RBI reduces interest rates to 0 and government borrows and spends, you grow at 12%. but will you sustain it? I mean, that will be a sprint. So I think the issue is what you require for a marathon. And I think the countries which have reduced poverty have run growth marathons in entire Asian system. And then I think among risks, we talked about global recession, geopolitics, inequitable growth. I think it's visible. I mean, it's not, you don't require, I mean, go to the market and check what is the demand for car, which type of car is in demand, which is not in demand. You get a sense who's making more money and who's making less money. So it's, so, and company-wise, the larger companies are doing well, the smaller ones are not doing well. So that is also reflected. So I think there is a dichotomy that is playing out. And finally, I think climate risks. I've been making presentations for 30 years now, and I've never used climate. I've never talked about climate while talking about the economics, only since last year. Maybe I'm trying to catch up, but the point is that climate risk is now staring at us. I mean, it's become very, very obvious. And unfortunately, India, if the global temperature rises, countries like India in South Asia get hit more than the countries in the West. So you are more vulnerable. And there are two entry points for climate change, I think, which I want to address. One is your food. And for India, it's very important for India because 18% of GDP still comes from agriculture, 40% people directly linked to agriculture. So if the food economy gets disrupted because of climate, then I think there is a so you can't change that, you can't reverse that, but you can at least mitigate that. So you'll have to take action so that you'll have to grow crops which are weather resistant, for instance. I think these kind of activities will need to pick up. So food is one part. Second is your carbon emission. India started off as agriculture economy, which most economies did. Then typically economy moves from agriculture to manufacturing to services. We kind of skipped the manufacturing part. Manufacturing share in GDP has been stagnant for quite some time. And the reason is pretty clear, because manufacturing requires very hardwired infrastructure. Services you can grow, you can bypass infrastructure in some cases. Just take the case of ITES. You produce your goods in some computers sitting in a big hall. How do you export it? You need a telecom connection. So the output is sent out to US, etc. So you completely bypass. You don't need ships to transport your product to the. So you wherever you could bypass, I think you very quickly. And telecom revolution happened at the same time. So if telecom had not happened, ITITs would not have happened. So they're all connected. I mean, so that's how the technology impacts the economy. Now we are trying to go back to manufacturing. Everybody is saying you need manufacturing to create jobs, etc. So when you move to manufacturing, when you create infrastructure, you actually become more carbon intensive. So your GDP, X amount of GDP increase is producing more carbon. Steel, cement, manufacturing, these are all very highly carbon intensive segments. So you will have to work more towards climate control, or at least because of the commitments you have given. So it becomes an important factor for India. So the PNI scheme that people talk about, CRISIL's assessment is that about 75% of the investment that is happening in PLI is green investment, because you have to do that. So that's why you hear green hydrogen, this, that. So I think climate has become an important embedded part of economic outlook now, and I think people are very focused. When they are taking decisions, they are exploring which areas in India are more prone to climate risk. Should I put up a factory there, or should I put up a factory in less prone areas? So it's got into the psyche now. So I think climate has become an important issue for the economy. And this is the last slide. So this is telling you what we lost out during COVID. So if there was no COVID, so this is GDP index 200, you would have grown at the red line. But because of COVID, your GDP fell. Now you're moving parallelly to the red line, but you're not able to catch up to that. So the gap between them is about 1.5 years of GDP. So you lost that permanently, unless you grow at 13-14% per annum. So that's the damage that COVID has done. So this may not be true for agriculture or for utilities, but for overall GDP, this is definitely true. So that, I think I still have a couple of minutes. That's why I put the Q&A earlier, because I didn't want it to be the last item. So please go ahead if you have any questions. Yeah.
Good morning, sir. Kshitish Gupta here. So I just had a question that one of your graphs, we saw that India has always done better in GDP growth than the rest of the world as a overall. And even in the 2008 crisis, when the financial crisis, India didn't get to competitive with the negative effect. So is that our population could be one of the factors that could be influencing it?
See, India is a domestically driven economy. So it is not, it is integrated with the world, but it is not that much dependent on the world. You have large consumption base. So you are able to offset a global tide. But if the crisis is both internal and external, then you have a problem, right? So 2008 was a crisis which was purely external, and the domestic demand, population, whatever you might call it, middle class, consumption class, they supported us. In 2020-21, COVID also hit the domestic economy very hard because your activity was restricted, so you got hit more. So otherwise, that is why people are hopeful that even if the world slows down, US, Europe go into recession, India will still grow at 5 to 6%. I think that's the basis is that it's a domestic demand replacement.
Hello, sir. So I have three different questions, all based on one country, that is China. So the first one is, as we all know, our rupee is weakening, and then we are heavily dependent on fuel from our imports, that is OPEC plus countries, and then we have trade deficit with majority of the countries like China and other specific countries where we are heavily dependent on imports from them. So how do we look ahead? I mean, what can we do to decrease that deficit so that at least we are at a strong position?
Well, I think that's not an easy issue to solve, and the efficiency comes in there. I mean, you are importing from China because China is providing you the cheapest. If the reliability is the same, it's providing you the cheapest stuff. That is why we're running a 100 billion trade deficit with China this year. Interestingly, I think with a friendly country, US, we run a trade surplus, and with an unfriendly country, we run a trade deficit. Now, I think government is trying to address it through Atmanirbhar policy, which is you will produce, so you are incentivizing production of things like electronics, mobile, we become exporters now. So that is how you reduce your dependence. But the problem is that most of the stuff for putting a mobile together comes from abroad. So you need those supply chains within the economy so that the chip production, the other production, they also start happening here. That's a slow process. I think it's going to take a lot of time. So in the meanwhile, I think you can't reverse this. So what India is and you will also have to reduce the tariffs. I think import tariffs. We are trying to sign foreign trade agreements with many countries. Australia is one, and Europe is going to be the other. UK. Now these will allow free trade, and I think so. But that will also challenge our competitiveness. If you are not competitive, then you will again end up importing more, and your exports will not find value. So that is why it is imperative for us to make the production system very efficient, whether it is the infrastructure is the bottleneck, or finance is the bottleneck, or regulation is the bottleneck. It still takes a lot of clearances if you want to set up a factory. I think the quicker you do that, the more we have a labor cost advantage, I think, comparatively, but the other things are very unfavorable right now.
And the second one is that, as we all know, there is a Western concept called decoupling from China. So, is it really possible, or it's just a concept that is superficially placed over there?
Decoupling from China will play out in parts. For critical things, the West is already trying to decouple, which is chips, for instance, and the other critical things like health, pharmaceutical, it's moving towards India now. But for your toothbrush, toothpaste, other things, I think, which are China is producing more competitively. Actually, it's producing other things also more competitively now. I think that you will not let go. I think that will continue, and only critical item dependence will go on.
And third one is, as we all know, we are already facing slowdown, and in this particular time, we have our neighbors like Pakistan and China already creating problems for us. So how well our economy is? Is it strong enough to face those challenges?
Well, I don't think we have any challenge coming from these are called frontier economies now. So I think that's a new term which has, emerging markets and then frontier markets. So there is trouble there. I think if there is trouble in the neighborhood, it's not very good. I think it will not reflect well on us. But I don't think it's a variable that I take into account for forecasting my GDP. It's not reached that level.
Okay, sir. Thank you, sir.
Thank you very much. I think I've run out of time, and I hope you found it useful.